Today I'm going to give you a short insight into what I do on a day-to-day basis. I'm going to be talking about capital allowances and how to make the most of them in your capital investments. Despite what you think, capital allowances tax relief relates to much more than just the expenditure on your mechanical and electrical installations in a project. Allowances are available to property investors, tenants of leased property and individuals who've incurred expenditure on property assets that they use in their trade or their business. And a property will contain movable items such as computers, desks and chairs, etc. But there are a lot of immovable items of plant and machinery, fixtures and fittings. These assets can be found in all types of non-residential commercial property, for example, hotels, offices, retail, industrial, business parks. And they will typically include assets such as WC fittings, kitchen fittings, alarm systems, heating, air conditioning, signage, racking, door closers, just to name but a few. Typically, a 4-star hotel will contain a lot more plant and machinery, fixtures and fittings than a retail shell or an office building on a business park. The capital allowances scheme allows for a deduction to your income or corporation tax calculation, resulting in a cash saving. The allowances are given in the form of an annual writing down allowance, which are given at different rates depending on the type of asset that you've spent your money on. The cash benefits are therefore taken over many years, and the annual cash saving can be speeded up with first-year allowances, such as the annual investment allowance, which I'm sure you've all heard of, especially when claiming the capital allowances on your company cars. The aim of this first-year allowance, or the annual investment allowance, is there to encourage the investment into new assets. Capital allowances are often likened to depreciation. Depreciation is used in calculating your profits, whereas capital allowances are used in calculating the tax that you must pay at the end of each year. So there are two distinctly different calculations and potential outcomes. In a loss-making position, capital allowances can be banked this year and then rolled forward into next year and claimed on future profits. You don't lose them. The key points to consider when making a claim: capital allowances don't expire, so you can make claims on historic expenditure. It's useful to note that the basic asset you claim capital allowances on also attracts a proportion of the costs associated with installing that asset. For example, the builder's work, site costs, professional fees. Claims can also be made on second-hand property, so this requires specialist calculation to evaluate the cost of the land and the building that the property sits on. Allowances are also available on demolition costs, for example, stripping out mechanical, electrical and public health assets. And residential properties are excluded from the capital allowances regime, otherwise we'd all be claiming them. And just to confirm, enhanced capital allowances were scrapped in April of 2020, so no more ECAs, I'm afraid. So in summary, the capital allowances rules are many and they routinely change. So what you thought you knew about capital allowances and how to claim them and what to claim on last year are probably completely different this year. So always ask for help when putting your capital allowances claim together, and work with your specialist and your accountant to get the best outcome.